Hello, welcome back to this week's market update. Today is Monday, August 17th, 2026, and we'll jump right in. Looking at our market performance, two out of the three major indexes closed slightly in the green last week as inflation data came in largely in line with expectations, even as the conflict with Iran continued to create uncertainty. As of Friday's close, the S&P 500 led with a 0.36% gain, followed by the Nasdaq Composite up 0.14%, while the Dow Jones Industrial Average declined just over 0.5%, weighed down by Cisco, Home Depot, Honeywell, and Amazon. Moving into our economic data from last week, as I mentioned, it was a pretty important week for inflationary data, with us getting both the CPI and the PPI for the month of June. Headline inflation came in at 3.4% annually, core inflation a bit below that at 2.5% annually, and then on a monthly basis, prices were actually up just 0.1%, slight increase from the previous month, but in a very healthy range, and then core prices were up 0.2%, still a pretty healthy pace there. One of the biggest contributors was the change in energy prices, so that was down 1.5% from June. However, you can see it was still up almost 15% from a year ago. Energy prices as a whole, more specifically, energy commodities were down almost 3% in the month, but still up more than 24% from a year ago. Other categories here, we had food at home, which is groceries, that was down 0.1% in the month, up just 2.7% from last year. Shelter also continuing to moderate. You can see it's the second month of 0.1% monthly inflation as the pace of inflation in shelter continues to cool. This month, it was an annual pace of 3.2% there. While inflation remains contained across many categories, there are still some geopolitical risks surrounding higher energy prices that continues to be a lingering concern for the inflation outlook. In the next slide, we'll take a look at wholesale inflation and how that's been a little bit stickier in the last month. Moving into our producer price index, our wholesale inflation, it showed small signs of improvement in July, with headline inflation coming in flat on a monthly basis. Core inflation, however, much higher at 0.4%, with the direct cost of energy stripped out from that figure there. On an annual basis, you can see we are a bit stickier at 4.7%, both headline and core there. It is an improvement from the prior 2 months, however, it's still quite close to 5, just a definitely above average figure there. By category, goods prices declined 0.7% during the month. That was mostly due to energy prices falling 3.1% in the month. Foods prices also falling at nearly 1% in the month of July. Other goods prices up just 0.1%, pretty healthy rate there. And then on the services side, we saw inflation at 0.2% in a pretty healthy range as well. Trade costs down, as well as transportation and warehousing. A lot of that is very much tied to energy prices, so it makes sense that those fell alongside energy. And then other services were a bit more inflationary at 0.6% during the month. Overall, the July data points to some near-term improvement in wholesale inflation, but with producer prices on an annual basis still running pretty high, a little bit below 5%, that is a key risk to continue monitoring. Following the month-over-month improvement in both the CPI and PPI, we did have the odds for a September rate hike fall quite significantly in the past week. Before the inflationary data, markets were pricing in about a 52% chance of a 25 basis point rate hike at the September Fed meeting. Following the updated data, those odds fell to just about 31%, and you can see the opposite was true here. This is the current target range for the federal funds rate. The odds that it stays the same jumped significantly there to just shy of 70% now for the September meeting. Following our inflationary data and changes in the expectations about rate hikes, we also got retail sales figures for the month of July last week as well. They came in below expectations, declining 0.6% during the month, although they were 5% higher than a year ago. Most of the monthly weakness was attributable to a decline in energy prices, as gas station sales fell 0.9% during the month, but were still well above year-ago levels. Non-store retailers, largely including online shopping, also weighed on the monthly figure, declining 2.2% in July. Other areas of consumer spending were more resilient, though, with dining and drinking establishment sales increasing 0.5% during the month and were up 5% from a year ago. Retail sales continue to be influenced by energy prices and geopolitical developments, making the headline figures somewhat volatile. While consumer activity has been uneven, the broader spending backdrop remains on pretty solid footing for now. Last but not least, looking at the consumer side of things, we did get the Consumer Sentiment Index from the University of Michigan. It declined in August following 2 consecutive months of improvement. You can see a slight decline there. The index fell about 7.6% during the month and was 12.4% below year-ago levels, reversing a lot of the improvement we had earlier in the late spring and summer. The decline was led by the index of consumer expectations, which fell 8.7% during the month, while the current conditions index declined a lesser 5.5%. The renewed weakness in consumer sentiment suggests that consumer confidence remains pretty subdued despite continued stability in economic activity. And that concludes this week's market update. We really appreciate you tuning in, and we look forward to seeing you again very soon. The information you have heard is the view of Synergy Asset Management as of the date of publication. These views and opinions are subject to change without notice. Investors should not act on any recommendation, express or implied, or information in this material without obtaining specific advice from their financial advisors and should not rely on information herein as the primary basis for their investment decisions. Information contained herein is based on data obtained from publicly recognized sources and is believed to be reliable and is not expected to be updated after initial publication. This information has not been independently verified, and Synergy makes no representations or warranties as to its accuracy. The material has been prepared solely for informational, educational, and market commentary purposes and is not a solicitation of advisory services or an offer to buy or sell any security or to participate in any trading strategy.